What's up guys? So in this video we're going to talk all about how to actually trade with zero risk. Okay, so maybe you're going to have to take a little bit of risk, but we're going to talk about how to manage your risk more appropriately so that you can take safer trades in 2023 and really be able to put yourself in a better position. And if you stick around to the end, I'm also going to show you a unique way that you can actually make money trading without having to risk any of your own money. So you'll still have risk on a per trade basis, but it's not going to be your own dollars that you're risking. So we're going to dive right into it. If you like content like this, be sure to smash that like button, subscribe, and let me know what you want to learn about next, and we can create it for you. So how do you take less risk in your trading, and how do you do a more efficient job of doing that? This is obviously something that a lot of new traders struggle with. They're either scared to take risk or they have trouble managing risk. They end up in situations where they win some, but then their losing trades are always worth more than their winning trades. How do we actually solve those issues? I'm going to give you a few things to think about today that I think will really help you this year to manage your risk better so that you feel better about the trades that you're taking and the direction you're heading. So point number one to think about in order to manage your risk is you need to consider the environment that you're in. And what I mean by that is right now you have lots of competing fears in the marketplace. You have inflation fears, you have recessionary fears, you even have political fears that are out there. And what those fears do is they create more sudden movements in the price of multiple different stocks, but probably the stocks that you're trading. So the market becomes more reactionary. And the problem that causes is if you have open positions that you've been holding for a while, you could have winning trades quickly turn into losing trades, and there's not really anything you can do about it if your strategy isn't appropriate for that kind of environment. So as an example of that, many of you may be swing traders. So you get into a position, you want to hold it for a couple weeks, a week, a month, whatever it is, and that's part of your trade plan. In fact, I did a lot of swing trading. So a lot of swing trading, especially in between 2018 and 2020. But my approach has changed. And the reason my approach has changed is because the environment has changed. It's going to be harder to be a swing trader in this kind of environment because reactionary news can cause otherwise good technical positions to end up as losers, and there's not really anything you can do about it. It's just a factor of the environment that we're in. So how do you solve that problem to take less risk? Well, you can think about becoming more of a day trader. So opening and closing positions in the same day. And that may sound scary, but ultimately a good strategy is a good strategy regardless of the time frame that you're using it on. And the advantage of being a day trader is if you're opening and closing positions in the same day, those reactionary news events don't really impact you. You're just dealing with what price, what that stock does on that particular day, and it's much easier to manage that kind of risk because you're in the trade for a much shorter period of time. So you can manage that environment risk by working on opening and closing positions in the same day, becoming a day trader. Obviously, you've got to have the right strategy. You need to understand the rules of day trading, but that's all stuff that can be learned, and it's an adjustment you can make if you're trying to make money swing trading now. So understand the environment you're in and how to adapt to that environment is number one. Number two is you want to think about how you can be more precise with your entries. And that really comes down to being able to do things on a shorter time frame. And the easiest way is just to give you an example of what this looks like. So what I'm going to do is pull up an example of a trade that I took on Friday so that you can see how you can manage and be more precise with your entries in order to take on less risk. And what I'm going to do is show you what most people do and then compare it to what I did and why you can take less risk by doing things that way. Okay, so if we look at this particular chart. This is just a chart of the S&P 500, and I have the daily chart over here on the left, the 1 hour chart over here on the right, so longer time frames. What most people would do is if they want to take a short position off of these highs, well, they may enter as price comes back down underneath of these highs and set a stop above where this high point was. The problem with this is a really large range. So this is, a 50 to 100 point range, and if you're going to take on that big of a range with your trade, you're either taking on way more risk, or you have to size down to the point where your sizing is so small that you're barely making any money. Okay, even if we break this down into something like a 15-minute time frame, and we're using the same set of highs, so this area in here, what most new traders would do that are trading off a longer time frame is they'd see these highs get broken. Okay, now you have one candle and then this next candle over here. If you want to be short, maybe you take it on the opening of this candle and then try to stick your stop above these highs. So I've created a shorter window here, so there's less room, but it's still a good chunk of space that I need to cover because I'm entering way down in here. I still got to cover this entire area with a stop, which again It means I'm either taking on more risk or I'm making less money because I have to size down smaller. This is the same exact window of space, but this is how I did this trade. So this is on a shorter time frame. I'm using the 5 minute and the 1 minute here, and you can see how precise this became. I was able to enter right here at 40.85 based on my criteria, and my stop is only 2.5 points long because I know based on this smaller time frame that it would not be logical for price to come above this point and continue going down. That kind of precision allows me to take on less risk. I can be much tighter with my stop. It means I can either take on less risk on that trade or I can size more appropriately and make more money. But that's how you be more precise, by using smaller time frames, and use those smaller time frames in order to take on less risk. It comes with understanding how to create more precise entries so that you can be tighter with your stop window. Okay, and that's tip number 2. Tip number 3 is to actually size appropriately in the first place. So before any single trade that you take, you should know exactly where your stop is going to be, where you're going to enter, where your profit target's going to be, and how much money you have at risk on that particular trade. That should never be a guess. Okay, you should always know the dollar amount that you have at risk and really the percentage of your account you have at risk on any given trade. One rule of thumb that my students like to use is, hey, we're gonna risk 1% to make 2, or we're gonna risk 1% to make 3. All that means is that out of your total account size, where your stop loss is, you're only risking 1% of your total account. So if your total account is $1,000 and you're only risking 1%, it means you're risking $10 on that particular trade to make 20. You're risking $10 to make 30. Same thing, you got a $10,000 account, you want to risk 1%, you're risking $100 to make 200. You're risking $100 to make 300. But that sizing and that risk reward ratio should always be positive. It should never be, I'm risking $100 to make 50, or I'm risking $300 to make 100. You should always have a positive reward to risk, and that comes down to understanding the sizing and the profit targets you have on any given trade. But by doing that, every single trade will have less risk, because every single trade will give you the opportunity to make more than you could lose. And that's really how you manage risk appropriately. Now, the last tip, and the one that I promised for you, is you can actually work on getting funded. So rather than risking your own money trading, you can get access to other people's money. They will give it to you if you meet the right qualifications and you have the right strategy. You can use other people's money to do the trading. Now, there's always going to be some additional fees related to that. You're going to have to give up a percentage of the profit. But for most people, making, as an example, 90%, keeping 90% of your profit off of a $50,000 account is going to make you a lot more money than keeping 100% of your profit off of a $5,000 account. And you're taking on far less risk because you're never risking any of your own dollars to do the trading. So that's another way that you can think about managing risk, is having a plan for getting funded. Now, getting funded isn't something that just happens automatically, or else everyone would do it, right? You need to have the right strategy, you need to understand the rules, the right relationships. It's all stuff that we help our students with, but those are all different ways that you can manage your risk to have a better 2023. So making sure you understand the environment that you're in and be able to adjust your time frame, able to be more precise with entries by trading on smaller time frames to narrow your stop window, being able to actually adjust your position sizing and always maintain a good reward to risk, and trading other people's money, if that's the fit for you, will allow you to take on less risk in 2023. So go ahead and put these things into action if it meets your plan criteria, and we'll see you on the next one.